what drives the economy. Now,
No,
I don't think the Fed are particularly good with that either. I think they do a terrible job on forecasting the economy. And that's why, FinTwit gets so angry with them. It's like, it's bloody obvious we're going into recession and you won the battle on inflation, but you're going to keep fighting it and you're going to make it worse for people. And then people are going to lose their jobs and going to be angry at you again, and so on and so forth. But nobody's ever managed to make the business cycle flat. Nobody. It's a degree of what volatility you'll accept. So, firstly, most people need to realize that doom porn sells. It catches attention. Fear is the strongest human emotion, right? And so you see a lot of it because it grabs attention. So we need to break apart to two parts here. One is, what do I think of the economy? And the other is, what do I think about markets? So my economic view is, I think most of us even know it, is we're in recession. We're in recession and it's probably going to get a bit worse. And there's a lot of people going to lose their jobs and businesses are going to find it hard. There's less money around and it's going to be pretty miserable. And it's the sort of miserableness that you go through periodically that is not catastrophic. So it's a recession. And recessions are as old as humanity itself. So we've just had, what's confusing people in my view is we're so screwed up by the last three events. One was the pandemic. So there's no normality. What was the recession look like there? That was the weirdest one. Then 2008 was the end of the entire financial system. And then 2001 was this spectacular tech collapse. So people have an anchoring bias. It's like, well, it's the end of the world. Really, when I graduated university, it was 1990. And it was a terrible time to graduate because it was a recession and there were no jobs. And I wanted to go into finance and they were firing people as fast as possible. And it took a while. House prices went down for a while and people didn't get jobs for a while and people were laid off for a while. And the stock market went down 20%. It was a decent sized recession as well. Went down 20%. Took some time to recover. The jobs came back. The economy was cleaner. They got rid of some of the worst excesses of leverage and the world moved forwards. And before you knew it, all of the 90s was a boom. I'm kind of that opinion, is we have no systemic collapse coming. We don't have those kind of issues, and we've invented the magic printer, the money printer of quantitative easing that papers over all the troubles. So we don't have that coming. Societally, yeah, we've got a whole bunch of issues to get through a US election with all this AI and the anger and the populism, but forget all of that. Again, you can easily go down the doom or you can enjoy the community you've got around you. And there's different ways you can have lenses, perspectives on the world. Investing, the job of markets is to look forwards. If you tell me 100% of all economists are forecasting a recession, it's kind of no shit, Sherlock. And therefore, is it in the price, or are all those stock market people really stupid? All of those machines that they haven't heard you at all? No, they actually understand this, and it's a real-time probability weighting business. So it kind of knows that. And what it looks forward to is, okay, how bad is this? Is it catastrophic? Is the world going to end? What's going to happen? And the markets are telling you, no. It's probably done. My view is the bottom is in markets, and the bottom was in crypto in June, and for Bitcoin was in October, November. The bottom was in for the stock markets in October, as most end of bear markets happen. It priced in a recession, and we move forwards from here. And eventually they'll cut rates again. And if you think about it, is we had a total shutdown of the global economy, then a reopening of the global economy. That's caused this inflation that's hurt everybody. And eventually we'll just rebalance back to some form of normality. There's a massive amount of doom porn about inflation is going to be structurally here forever. We're all going to die, which is kind of, I'm more like you are with the AI side, where I'm actually like, you know what? We've just developed AI. We've got relentless technology. The price of energy is coming lower from all different sources. Productivity of humanity is growing. So I think I think it's actually probably an interesting time. It's an interesting time because everybody's so bearish. Psychology plays a huge part in markets because everybody expects inflation to be relentless and ongoing and for the rest of our lives, much like, 24 months ago, everyone was like, every tech stock's going up forever and every business can never fail again. We're humans, right? We make forecasting errors of quite wide amounts at various points. So yes, no, I spend so I'm not just saying this because I'm just chatting to you. I do an enormous amount of work on this. I write 150 pages of research. I sit down and write it every month. I've been doing that for 19 years. And so that comes with 2,000 charts and models and stuff with myself and my colleague Julian Bittle, from secular themes, short-term themes. Doesn't mean I'm not wrong as well. I could clearly be wrong, but I just think it's in the price. And the worst part of it is the stock market's going to be going up probably. It won't rocket up at first, but eventually it'll pick up while we're all feeling the pain. There's a time horizon of how the business cycle works. Currently, the thing that leads it the most is the Chinese credit cycle. Who knew? But it is right now 17 months ahead. So when it turned up 17 months ago, we're starting to say, okay, there's something happening here. It also forecasts the recession. And then you've got other forward-looking indicators about 9 months out. We've got a bunch of indicators. But the last thing in the stack is rents. And the one before that is wages. So wages are going up right this now, but they take a while and then they start coming down again. They won't deflate. Nobody's going to really come to you and force you to take a pay cut, but it means that they don't keep going up. But your rents will probably come down. And so that's a function of, these things just take time. The unemployment rise hasn't even started. Now, we can see everybody laying off. Every company's laying off people, thinking about tightening costs. Everyone can see it from sponsorship, advertising, sales. I mean, it's everywhere. I mean, every single person I speak to is like, Christ, it's miserable out there. But the unemployment side doesn't really come until it should start in the next month or two. And then that goes on for 9 months of just relentlessly higher unemployment rates. So anybody watching this...
Why is that so predictable? Why 9 months?
It's just how it always is, because companies make decisions, and whether it's around board meetings, however it's done, they get to a certain point where they hit the panic button and they lay people off. That's usually when the bottom of the recession starts. It's usually when rates start getting cut. It's usually when the stock market often recovers as well. So for people watching this, there's two parts of this. One is, if you're an investor, you might be able to buy these technology stocks with this renaissance of amazing changes happening around us at prices down 70% from where they were 2 years ago, a year ago. Okay, that's kind of interesting because your expected future return goes up. Same with crypto. You and I have talked about this. You buy when the business cycle brings it back to the bottom of the secular uptrend. That's where we are. These are where you make all the money. This is what you get paid for, to take risk here. You don't get paid to take risk at the top, and you tend to lose money. So these are the moments in time. So that's very interesting as an investor. But anybody watching this, think about your cash flows. Just think about your cash flow, think about your expenditure, and just be a little bit careful, because losing a job or having your own business struggling for a period of time, and I think the worst of it will be over relatively fast, but yeah, it's these laggy effects. Some of the economic cycle is in the next quarter. So I think we've got a really ugly quarter to come. But the problem is, it's that shock that sets off the companies to go, I need to lay off some staff, all of that. And it's that process that begins the healing. The shock coming in the next quarter is the general slowdown from interest rates, biting into all of these indebted companies or households or credit cards and all of this stuff. And everybody goes, I'm not going to spend money. That is what a recession is. It's not usually driven by a pandemic. It's not usually driven by the entire financial system collapsing. It's usually by all of us making a rational decision of, I'm just not going to spend money right now because things are a bit uncertain. And that is what causes recessions. And I'm actually telling people to do exactly that because it's the rational thing to do. What you do, if you're going to panic early. And I'm not talking about the stock market going down either. I think we've had that. It went down, the NASDAQ went down 38%. That's pretty much bang in line with a regular bear market. But what I'm saying is in your personal life, where it really matters, where the rubber hits the road, is panic early. Just look at your expenditure, look at your cost, look at your business. So what do I need to do here just to make sure that I can just get through a pretty shitty year? But 2024, probably pretty decent. So the market is expensive. Interest rates have gone up, so people are going to buy less houses. Yes. Will house prices come down? Yes, because they went up a lot. Will the activity in the housing market dry up for maybe 2 years? Yeah, most likely. Are we going to see a leverage crash? No, because nobody's really got a lot of leverage at household level in property. That was something that happened in 2008. It's been too expensive and too difficult to do. So I think the home builders have a bit of trouble because they got a lot of inventory. They can't sell it. They need to finance it for a couple of years. It sits around 1990, 91, 92 was very similar. I was in London then. It was pretty shitty in the property market. It was great for me because I just entered the property market at the end of that. So prices were relatively low. They hadn't come down a lot, but they hadn't gone up a lot. And my income was going up because I was in my 20s. So your income goes up every year because you're hopefully getting promoted and stuff like that. So, but, you know, a few property developers went bust. Things were slow. And then eventually it cleaned up. So I'm more of that opinion that, you know, house prices come off 10%. Maybe even 15%, you know, some areas that were really hot come down a bit further, but it doesn't expose any catastrophic leverage. The banking system is more than adequately compensated with capital. It's hugely solvent in the United States. So it's just a bad time.